Good afternoon, my host. Can you confirm whether you can hear me and see my screen?
Good afternoon, sir. I can hear you and see your screen.
Okay, thank you. Good afternoon, everyone. You are welcome to our SFM class on this platform. Today, we shall be rounding up our discussion on this platform, after which I will have to wish you well in your forthcoming examination. So without wasting our time, let me first apologize for not being able to hold the class on Thursday, and that was the reason why we have to fix this class. Okay, we are still on currency risk and interest rate risk management, and yesterday we were able to conclude the currency aspect of the hedging. Today, we are going straight to interest rate risk management. That is the second aspect of the hedging. Let me go straight to the next question there, which is question number 5. Abi, is it question 5? No, that should be question 6. We saw question 5 yesterday. Okay. Question 6. Okay. So this is where we have. I will read the question, explain, and we solve accordingly. Let's go to what the question wants us to do here. Okay, look at it. We are asked to determine the outcome of the hedge, assuming NIBOR has increased by 3% or decreased by 5% in 3 months' time. Okay? That is it. We want to determine the outcome of the hedge if NIBOR increased by 3% or NIBOR decreased by 5%. Okay, let us take the question, then I explain to you. Olamide Limited needs $20 million in 3 months' time for a period of 6 months. The company can borrow at NIBOR plus 150 basis points, and NIBOR is currently 7%. The company wishes to hedge against unfavorable movement in interest rate using FRA. The available FRAs are 3 versus 9, 10%, 3 versus 12, 15%, and we have 3 versus 6, 8%. Now that's the question. Before we solve the question, let us quickly explain the nature of interest rate risk. Interest rate risk is the risk that interest rate will move against unfavorably against the borrower or the lender of a particular currency. Normally, a company can borrow at one of two rates, which is a fixed rate and what? And variable rate. If a company can borrow at a fixed interest rate, the fear of the company is that interest rate can fluctuate, okay? Interest rate can fluctuate in such a way that if interest rate reduces below the fixed interest rate, it means the company will not be able to take advantage of what? Of the drop in what? In interest rate below the fixed rate. If, however, the rate increased above the fixed rate, it means the company will what? So, hooray, oh, thank God I borrow at what? Fixed interest rate. But our major concern here is not on fixed interest rate, rather on what? On floating interest rate. Floating interest rate is another name for variable interest rate, okay? Now, for every company that is able to borrow at variable interest rate, The fear is that whenever interest rate increases, then the company will be asked to pay more interest. Are we together? The company will be asked to pay more interest if interest rate has increased. Therefore, the company might want to hedge that what? Unfavorable movement in exchange rates. Okay? That hedging strategy is what we call interest rate risk management. Okay? Now, we have what we call the base rate, and we have what we call the basis point. The base rate is the risk-free rate, okay? The base rate is the risk-free rate. That risk-free rate can be called various names depending on the country in which that transaction is taking place. For instance, in the UK, it is called LIBOR, which is London Interbank Offer Rate. Okay, LIBOR, which is London Interbank Offer Rate. In Nigeria here, we call it NIBOR. NIBOR means Nigeria Interbank Offer Rate. While in the US, they call it a US Prime. Okay, it's called US Prime. Now, that a company cannot borrow at the NIBOR because NIBOR is the risk-free rate. Okay, NIBOR is saying our risk-free rate. I believe we all know what is risk-free rate at this level. Isn't it? This is just a lecture class, so I'm just taking my time to refresh your memory. The NIBOR is the risk-free rate, and no bank will be borrowing you at what? At risk-free rate. Instead, a bank will be borrowing you money at risk-free rate plus certain amount of what? Percentage. That percentage is a function of your financial risk. Let me say the risk-free rate is 10%. If bank want to borrow you, for instance, the bank can tell you that, oh, we can only borrow you at 10 plus 2%. That additional 2% above the risk-free rate is what we call the basis what? The basis point. Okay, and that is dependent on your what? On how dear your company is. We call it financial risk. Now we have a rating agency that rates all companies according to their credit worthiness. Okay, we can have AAA rating, we can have AA rating, we can have BBB, we can have BB plus, we can have AA plus. It depends on the categorization of your what? Of your GRE. Are we together? So what I'm trying to bring out here is that the total borrowing rate of a company is the risk-free rate plus what? Plus the basis point. Now, nobody will hedge your basis point. What you are hedging is the NIBOR. Okay, it's the NIBOR, which is what? Which is the base rate. We call it the base rate. It is only the NIBOR that you can hedge. Nobody is willing to hedge your what? To hedge your basis point. Are we together? So it therefore means that your fear is that the basis point will what? The basis rate will what? Will increase. That is your fear if you want to borrow. While your fear if you want to lend is that it will reduce. Are we together? And that is exactly what you want to hedge. So look at it, for instance, in this question, we have NIBOR plus 150 basis points, isn't it? Now, what you can now hedge is the NIBOR. You cannot hedge that 150 basis points. I believe that is clear. Okay, so if that is the case, for you to hedge, you have alternatives. You can hedge using what we call the forward rate agreement. You can hedge using what we call interest rate futures. You can equally hedge using what we call interest rate option, and as well as interest rate swap. So we are going to try to look at this in details. Now, for forward rate agreement is a binding contract which a company enters into with its banker in order to fix interest rate now that apply to future borrowing or lending. What am I saying here? Assuming I want to borrow in a future time, I don't need the money now, okay? but I need money, let's say in December, which is 3 months time, for instance. But my fear is that interest rate will have increased on that particular date that I want to borrow, isn't it? That is my fear. So I can approach my bank and say, come, I need this also amount in 3 months time, but I want to fix interest rate now that will apply to that future borrowing. You understand? So that whatever happened to interest rate in that on that date is no longer my concern. So that particular strategy is what we call forward rate agreement, and it's a binding contract. Once you enter into that contract, it becomes you cannot back out of the contract. Now, the major disadvantage of forward rate agreement is the fact that it does not allow the borrower or the lender to take advantage of a favorable movement in interest rates. If interest rates, you have envisaged that interest rate will increase and eventually interest rate reduce, then you don't have option down to what? For you to honor that contract. So it means you will not be able to take advantage. That is the major disadvantage of what? Of forward rate agreement. Okay, now, how do you establish the appropriate rate or appropriate contract that you need to buy or enter into, so to say? Okay, how do you establish or identify what is the appropriate contract you need to enter into while using forward rate agreement? This is the rule. Now look at it. This company says, Olamide Limited needs what? 20 million when in 3 months' time, isn't it? And in 3 months' time, for what? For a period of 6 months, isn't it? So for me to decide what contract we apply, I will say 3. That is the period from when I will need that money. That period from when I will start the borrowing, that I will actually borrow that particular amount. That is in 3 months' time. Then you will add it back. You add it to the length of time you are going to use that money. Okay. So if I say 3 plus 6, that is 9. Okay, so I will now say it means that the appropriate forward rate agreement I need to enter into is 3 versus 9. Your 3 there is what? The period when you will actually need that money, and the second part, which is the 9 there, is the date you need that money plus the length of time you will use the money. So in this question now, I can say my appropriate rate is what? Is my appropriate forward rate agreement is 3 versus 9, because I will need that money in 3 months' time and I use it for a period of what? Of 6 months. So I will enter into 3 versus 9 forward rate agreement. Okay, 3 versus 9 forward rate agreement. Can you see that? 3 versus 9 forward rate agreement. And that will what? That will fix the interest rate at what? What rate do we have there? The appropriate rate for 3 versus 9 is what? Is 10%. So I will enter into this agreement and fix the exchange rate at 10%. Meaning that in that 3 months' time, whatever happens to interest rate is no longer my concern. Okay, whatever happens to interest rate is no longer my concern. Effectively, I have been able to fix interest rate at 10%. Are we together? So what now happens? How will you now know at the end of the period when you'll be borrowing whether that contract is favorable to you or not? Okay, this is what I'm going to do. We have entered into 3 versus 9 forward rate agreement and fixed interest at this, isn't it? Okay. Now, if interest rates, are we together? If interest rates increase by 3%, look at it, that's what the question says. If interest rates increase by 3%, what does that mean? It means I'll be paying 13%. Okay, I'm coming, let me see our rate here. Okay, please, change this one to 10%, that's 7%, change it to 10%. Okay, change that 7 to 10%, because that's our base rate, Abby. So if interest rates increase by 3%, it means in addition to my current base rate, I will be paying additional what? 3%. So the total interest I'll be paying on that date when I'll be borrowing is what? Is 10%, isn't it? Sorry, it's 13%. So this is the 13%, the actual interest rate, okay, actual interest payment on the transaction at the end of the contract, that is the date you want to borrow. What is the actual interest rate? Use it to calculate the interest payment. That is 13% of 20 million. 13% of 20 million times 6/12. Because we are using the money for how many months? We are using the money for just 6 months, okay? For just 6 months. So it will be 6 out of 12 months. So multiply that 13% by 20 million by 6/12. I get my what? 1.3 million. That is the interest rate that we apply if I have not hedged. If I have not hedged, this is what I will have paid. This is what I will have paid because presently my interest rate is 10%. I said you should change that 7% to 10%, Abby. And interest rate now increased by 3%. So what is the total interest rate? 13%. If I did not hedge, I will have paid 13%. I will have paid 13% if I had not hedged. But because I hedged and I have entered into forward rate agreement to fix interest at 10%, then after paying this amount, I will go to my bank and say, come, we have fixed interest at what? At 10%. But eventually, I've been able to borrow at 13%. So it is above the what? It is above the agreed rate. The agreed rate is 10%. So what happens? The bank needs to compensate me for 3% increase. So that's why I said what? Compensation from bank. Compensation from bank is 3% times 20 million over times 6/12. This is the compensation I will receive from the bank. My compensation will reduce my payment. Can you see that? It will reduce my payment. So now, in addition to this, don't forget, we have margin above NIBOR. What's the margin? The margin is 150 basis point. I told you, nobody will hedge this one for you, Abby. So you have to recognize that separately as your own liability. So 150 basis point is the same thing as 1.5%. 150 basis point is the same thing as 1.5%. To convert your basis point to percentage, simply divide the basis point by what? By 100. By 100. So I have 1.5%. That is what I'm paying about. You know, I have hedged using NIBOR. But now, sorry, I have hedged my NIBOR using FRA. But I did not hedge that 1.5%. So that is an additional rate I will need to what? I will need to pay. That's what we call margin above what? Above NIBOR. Margin above NIBOR is 1.5% times 20 million times 6/12. So it's 150,000. So the net interest payment is 1,150,000. 1,150,000. That is my net interest payment. That is my net interest payment. I said that's 6/12. We are borrowing for how many months? 6 months now. We are borrowing for 6 months. We are not borrowing for 1 year. So will you use rate of 1 year? No. We are borrowing for just 6 months. The interest rate is per annum, and we are borrowing for 6 months. So you need to take 6 months equivalent of your borrowing. Do you understand? Okay, thank you. Now, you can now compute your effective interest rate. Your effective interest rate is computed as outcome divided by your exposure, okay, multiplied by 12/6. Now, let me explain why I'm having 12/6 here. You know that this interest has been computed based on what? 6/12, Abby? This is 6-month interest, don't forget. This is 6-month interest. But if you want to compute your effective interest rate, your effective interest rate must always be computed per annum, okay? So you have to go and gross it up. From 6/12, you take it back to what? You take it back to per annum. And that you can do by just multiplying by 12/6. So effectively, we have borrowed at 11.5%. We have borrowed at 11.5%. Okay, so that is forward rate agreement. That is forward rate agreement. Forward rate agreement is just like gambling. Okay, forward rate agreement is just like gambling. It's like gambling. It means you are gambling, and what? Someone is telling me 1.3 million minus 300,000 is 1 million. So do you want to throw away this 150,000? You are seeing everything there now. This is payment. This is received from the bank. So this one minus this is what? 1 million. What about this 150,000? The 150,000 is there now. Yes, Mr. Ogochi, you can as well do this. Okay, you can as well do your 10 plus 1.5. Okay, you can do that, but whenever a question asks you net interest payment, look at what the question asks you. Determine the outcome of the edge. Okay, the outcome of the edge means that the examiner wants to see the actual amount of interest you have paid, not the what, not the other one. So you need to what? Show the compensation, how it flows. Okay, you need to show how it flows. Do you understand? You need to show how it flows. Okay. That is that about forward rate agreement. Don't forget, today is our last class, and we have a lot to cover on this platform. That's why I have to make it snappy. So let's go to question 7. I was telling you, let me complete that. I said interest forward rate agreement is like gambling. It means the bank is gambling, you are gambling. Okay. If interest rate has increased, the bank will compensate you. If interest rate has reduced, you compensate the bank. So you are not paying any premium. There's not, if there is premium, I will tell you now, you are not paying premium. This is what you need to do, is what I have explained. If your interest rate has increased, you what? Excuse me, you receive compensation from the bank, and if interest rate has reduced below the agreed rate, then you pay compensation to the bank. Do you understand? That's how it works. Now let's take question 7. Question 7 says, calculate the result of the edge if in September NIBOR has moved to 12%, that is A, and B 9%. Okay. It is now 1st June. Kuda Aero PSC, we need a loan of 150 million for 3 months, starting on 1st September. NIBOR is currently 10%, and the company can borrow at NIBOR plus 1%. The company is considering hedging its exposure using interest rate agreement, interest rate guarantee rather, using interest rate guarantee as opposed to forward rate agreement. An IRG agreement was reached with its banker at 11%. The bank quotes a premium of 0.25%. Calculate the result of the edge if in September NIBOR have moved to 12% and 9%. Now look at it. This is the difference between interest rate guarantee and forward rate agreement. In interest rate guarantee, this one here, that's what we want to use. We want to use interest rate guarantee. And for interest rate guarantee, it means the bank is guaranteeing you that you are not going to pay above this. If you pay above that, the bank will compensate you normally, understand? Now, what's now happening is that you have an option, okay? If you are using interest rate guarantee, there is an option. It's not a binding contract. Don't forget, I told you, forward rate agreement is what? It's a binding contract. You cannot run away from honoring the agreement, okay? But interest rate guarantee is what? It's not a binding contract. If the agreed rate is not favorable on my transaction date, I can walk away. Do you understand? So because of that option that you have, that is what is making you to pay premium. anytime you have an option, you have to pay premium because it means the other party might be losing out. You understand? So anytime you have an option, you are paying premium. And what give you option is interest rate guarantee. Are we together? So the difference between interest rate guarantee and forward rate agreement is the fact that for guarantee, you are not bound by the what? You are not bound by the contract. You can run away from the contract if it is not favorable. Are we together? Okay, so let us solve this question. What we are going to do, if you want to evaluate interest rate guarantee, is that you will compare the neighbor at the end of the period. Don't forget, I'm emphasizing it to you that what is being hedged is what? Is your neighbor. What is being hedged is your neighbor. Nobody is hedging your basis risk, okay? Borrow with the agreed rate. If the agreed rate is favorable, I will what? I will honor the agreement. If the agreed rate is not favorable to me, then I simply walk out of that agreement and go and borrow at the more favorable rate. I believe that is clear. All right. So that is simply what we are going to do here. That's the difference. Look at it. Situation A, situation B. For situation A, on the transaction date, NIBOR has increased to 12%, and for B, on transaction date, is at what? It has changed to 9%. And what is the rate in the IRG? In the IRG, the rate is 11%. Abi? Okay, I will now look at it. On my transaction date, is it better for me to borrow at 12% or to borrow at 11%? It is better to borrow at 11%, isn't it? So I will say yes, honor the agreement. Okay, honor the agreement, yes, because it is better for me if I honor that agreement. I will be able to borrow at 1% less than the basis rate, okay? 1% less than the basis rate. Okay, but for B, this is the NIBOR and this is the agreed rate. Will I honor the agreement? No, because it is better for me to borrow at NIBOR rather than the agreed rate in the interest rate guarantee agreement. Are we together? So that is why you have no, okay? No, don't honor that agreement. Simply walk away. All right. How do I now evaluate the edge? To evaluate the edge, I'll come and calculate my actual interest payment. Actual interest payment. My actual interest payment for A, I'm using the agreed rate, so 150 million times, I'm borrowing for just 3 months. So it's 3/10. I get this. Then for the second situation is 9% spot rate times the same amount for 3 months. I have this, but I have paid premium. Okay, the question has told you the premium to pay. The premium is 0.25. The premium is 0.25. I think I computed it somewhere. Look at the premium. Look at the premium payable here. It's 0.25%. You don't prorate the what? You don't prorate the premium. The premium is straight, okay? Just multiply the premium rate by the amount of exposure. So this is my premium payable. That is premium payable. Okay? So that premium will what? The premium will increase my payment. Look at it, premium paid. You can see it, it should increase my payment. Then above NIBOR, I can borrow at 1%. Is NIBOR plus 1%. So margin above NIBOR is 1% of this times 3/12, which gives us this and this. So the effective interest, the net interest payment is this and this, respectively. That is the difference between interest rate guarantee and forward rate agreement. Forward rate agreement is what? It's a binding contract. So if it is not at the end of the contract, one party will be settling the other, okay? The difference in either increase or decrease in NIBOR. And for IRG, you simply walk away if it is not what? If it is not favorable for you to use the IRG rate. Okay, before we continue, let me take your question in the next 2 minutes. We are not wasting time. We are not wasting time at all. We are not wasting time at all. So let's go. Let me take your question in 2 minutes, in just 2 minutes. Roll in your question, I attempt to read, then we go to the next question. I'm waiting for you. When it is at 2:46, I will go to the next question, please. Question, please. Okay, let me take your question. Yes, I got that 1.5 by dividing 150 basis point by 100. I told you to convert basis point to percentage, simply divide the basis point by what? By 100. So I divided 150 basis point by 100. I got my 1.5%. I can't revisit the IRG again. You just tell me your challenge. We have a lot to cover. You tell me I didn't understand this particular part. I will repeat that, please. You can't say I should go over it again. No, now we don't have that time, please. Yes, the margin above NIBOR in that question is 1%. Can you see that? They said the company can borrow at what? NIBOR plus 1%. That 1% is the margin above NIBOR. And that's why I say it's what? It's a function of your GNE level, okay? It's a function of your GNE level. So nobody will hedge that for you. You have to pay it, okay? You have to pay, nobody will hedge that for you. Which question again, please? Okay, for the IRG, okay. Okay, let me go to the question on IRG so that you can pick whatever you want to pick from it. Okay. Okay, this is the question on IRG. This is the question on IRG. So take whatever you want to take from there before we move on. Have we done that? Have we done that? We are not looking at the one that is, they are independent now. The two are independent. A is not dependent on B. B is not dependent on A. They are two different situations. The question is one acceptable. Okay, this one is independent of this. So we are not comparing them. We are not comparing them. You understand? It's two different conditions. Condition A, condition B. So they are not related at all. We are not trying to make comparison. Okay? We are not trying to make comparison. Okay? So, question 8. Let's go straight to question 8. Question 8. Now we are required to what? Assuming that Rumpel takes out a loan at a fixed rate of NIBOR plus 1% at the start of the loan. Illustrate the outcome of the futures contract if LIBOR is on the transaction date 4%. Okay, sorry. If LIBOR is 4% at the transaction date. Okay. Okay. Now, you can see what the question asks you to do. Illustrate the outcome of the futures contract. So here, you have to know straight that this question is on what? Is interest rate futures. Thank God, we have already taken interest rate what? Currency futures, isn't it? So it's just a build on to currency futures. Just a slight difference between the two. So we are going to see that. Let us quickly take the question. Let us quickly take the question. Rumpool Incorporation will shortly be making a short-term investment and want to borrow $4 million for 3 months, starting in 3 months' time. However, interest rates are currently volatile, and it is worried about adverse movement in this rate before it takes out the loan. LIBOR, the base rate, is currently 3.5%. Rumpool can currently borrow at approximately 1% above LIBOR. Can you see that? That is the basis point we are talking about, okay? So, Rumpool Incorporation is considering using interest rate futures to hedge the $4 million loan. It is now 1st of March, and the Chicago Board of Trade is quoting the following prices on standardized 1 million 3-month contract. Note that these prices are quoted in basis points at 100 minus annual yield. Then we have March, we have June, we have September contract. Contracts are assumed to expire at the end of the quoted month. So we have to hedge using futures. Now, what is the difference between interest rate futures and currency futures? You know, I said in currency futures, if you want to borrow, your fear is that interest rate will what? Sorry, exchange rate will increase, and that's what you want to hedge. And I said there's an inverse relationship between future rates, the futures price, and the exchange rate. Therefore, if my fear is that if exchange rate will increase in the future, then it means the futures price is expected to fall in that futures time. The implication is that currently the future is expensive. That was the principle I gave you under currency futures. Here, it's still the same principle. Only that in this regard, we are not making reference to what? To currency, to exchange rate. Here, we are making reference to our interest rate. The same inverse relationship exists between interest rate and what? And the futures price. And then what's that relationship? When interest rate declines, futures price is expected to fall. Why if interest rate increases, then futures price fear is that interest rate will increase against me, isn't it? So it means in that futures time, if interest rates increase, what happened to futures price? Futures price will have dropped. So what we do now is the futures is expensive now. So I will enter the edge by what? By selling. So that in that futures time, if interest rate actually increases, then the futures price will go back and make profit. Are we together? Okay. Now, we have a standardized market where futures are being traded. Okay. Standardized market, just like your stock market, where futures are being traded. Market where you can buy or sell futures. And the rule is that if you want to borrow, you what? You enter by selling and close by buying. And if you want to lend or you want to deposit, you enter by buying and close by what? Close by selling. Don't cram it. I've told you the principle. There is inverse relationship. The principle is what I want you to grab, not you cramming the. If I cram it, I will come here and be telling you this. You understand? It's understanding. Once you understand it, you won't have any issue. Let me repeat it. Let us assume that currently interest rate is 10%. Okay? In the future, my interest rate is 10%. The implication is that the futures price will be what? Will be 90, because the difference between 100 and the interest rate will give you the futures price. Meaning that the futures price plus interest rate should sum up to what? 100. Okay? The futures price plus the interest rate should sum up to 100. So if I am given the interest rate and I want to get the futures price, what do? I will simply deduct the interest rate from 100. The balance is the futures price. So if my current rate is 10%, what will be my futures price? 90. Now, if I want to borrow, and I believe that in 3 months' time, interest will have increased to 20%. If interest rate actually increases to what? To 20%, what will have happened to my futures price? Futures price will have reduced to what? To 80 naira. Do you understand? That's the inverse relationship I'm talking about. Therefore, it means as at the time I enter into that futures market, the future is expensive. The future is being traded at 90. So what should be my strategy? My strategy is that it is better I sell that future at that time for 90 naira. And when interest rate actually increases, futures price has dropped to 80. What will I do? I will buy it back. So the difference between the amount for which I have sold initially and the amount I am buying now will represent the profit I'm making on that futures. Are we together? So that was the point I was trying to make. Excuse me. I believe that is clear. Okay, let me see. I have some charts here. Which solution? The solution that I have not started, should I just be showing you the solution then without explaining the principle? Because I saw that you are eager to see the solution. Abi, I'll still go to the solution. Let me explain the principle to you. The solution will make no sense to you if I don't explain the principle behind the solution. You understand? Okay, so let us take the principle first. Don't worry, we are coming to the solution. Get the principle clear first. All right. Now, which contract do you need to buy? We have been able to explain when to buy and sell, Nabi. Now, we have to remember that whatever you do to enter the market, you are doing the opposite to close out. Okay? If you enter by buying, you have to close by selling. If you enter by selling, you have to close by buying. Are we together? Okay. Now, if you want to hedge using futures, this one, determine whether to sell or buy futures. Okay, I've put say that. And number two is that what contract do you need to buy or sell? What I believe we have our daughter with us. Jot it down. Number one is to determine whether to buy or sell. I haven't decided on that. The second step now is what contract to buy or sell. The rule is that you buy or sell a contract immediately after your transaction date. If your transaction date is, let me say, October, then the futures you are going to buy is going to be December futures, because December futures is one mature that matures after November or after October rather. Now, another thing you need to understand is that future contracts are standardized contracts, and they are available for every quarter source contract and the December futures contract. Are we together? So you buy the contract that matures immediately after your transaction. Now, having decided on the type of contract, the one you have to buy, the next one is to compute how many contracts do you need to buy. Because we are dealing with standardized contracts, you need to get how many contracts do you need, because you might not be able to use it to all because you are dealing with standardized derivative instrument. Okay, if that is the case, the formula for computing, what do you call it? The number of contracts to buy is your exposure all over contract size times loan period over 3. I also get loan period, that is the period for which we are going to use that loan. All over the 3 there is what? Is the contract maturity period, 3 months. So the 3 there is constant. Okay, having established that, the next one is now to go and compute your profit or loss on the futures. Profit or loss on the futures. You will be computing the profit or loss on the futures by comparing the opening futures price with the closing futures price. Opening futures price, you compare with the closing futures price, able to know whether you have made a profit or loss on that future. Okay, the formula, right? The formula is number of contracts is equal to exposure all over contract size multiplied by loan period all over 3. Loan period all over 3. Okay, that is it. Okay, I've repeated Mr. Gochi. Thank you. I repeated that. So you now have to go and determine the profit or loss. I mean, I said you compare the future price with the closing futures price to see whether you have made a profit or loss. Now, in comparison, you have to know where your closing futures price is given. If it is given, thank God, your work is less stressful. If it is not, then you compute the closing futures price using the concept of your basis, okay, which I'm going to explain as we progress. Okay, I'm going to use this question to explain it so that we don't waste time. Now, when you are done with that, go and compute your total profit on the edge, then carry out the evaluation of the edge. That's all. Then you can now compute your edge efficiency and effective exchange rate. Sorry, effective interest rate. We are dealing with interest here, sorry. Okay. So, follow the principle to solve this question now. Look at it. Because we are borrowing, as the company should say what? June. Okay, let me see. Why am I saying June? Let me show you the reason why I'm saying June. It's not what? I think they gave us, let me see. It is now 1st of March. Can you see that? It is now 1st of March. And when will the company need this money? Okay, the company want to borrow 4 million for 3 months, starting when? Starting in 3 months' time. Starting in 3 months' time. So if you count from 1st of March, if you count 3 months, that will be May 31. Abi? 1st of March, if you count 3 months, that should be May 31. After May 31, because May 31 becomes my transaction date. So the contract that matures after my transaction date is the June contract. Can you see that? Is the June contract. That's the contract that matures after my transaction date. Okay, I haven't gotten that. I believe you understand how I got that now. Okay. So sell, because we are borrowing, sell June future contract at what? The opening futures price, which is what? 96.1, which is 96.1. So number of contracts. My exposure is 4 million. My contract size is what? 1 million times loan period. I'm using the amount for what? 3 months. For a period for our contract expires every 3 months. The 3 there is constant. So that is 4 contracts. We are buying 4 contracts. Okay? We are buying 4 contracts. Now, if you look at this question, you will see that closing futures price is not given, right? Closing futures price is not given. So I need to estimate my closing futures price. How do I estimate my closing futures price? I'll be using the concept of basis to estimate my closing futures price. Now, basis is given as current LIBOR minus current future rate. Okay? Now, look at it. If you look at my futures price, is what? 96.1. So who can tell me what is the futures rate? What is the futures rate? What is the futures rate? My futures price is what? Is 96.1. So what is the futures rate? What is the interest rate in the futures market? That's what I'm asking. Anybody? 3.9. That is 100 minus what? 96.1. I told you the two will sum up to what? 100, isn't it? Okay. So 3.9 is the futures rate. So the difference between the current LIBOR and the current futures rate is what we call the basis. That's our total basis. Okay, that's our total basis. And it is expected, which futures did we buy? We bought June futures, isn't it? June futures. We bought June futures. So it's expected that should be 0 on the day that the futures will expire. Meaning that on the day the futures will expire, both the spot rate and the futures rate should be the same. That's what it means. But I am not waiting until June before I close out. So on the date I want to close out, which is May 31, there will still be some basis left that has not expired. That is what we call the unexpired basis. Okay? We call it the unexpired basis. So how do we get the unexpired basis? The unexpired basis is the proportion of, look at it, from March 1 to May 31 is 3 months, Abi? From May 31 to June 31 is 1 month. We have 1 month unexpired. So you now take the appropriate rate here. It will be 1/4 times minus 0.4. That is 0.1. That is my unexpired basis, minus 0.1. Let me see your question in that aspect before I go further. Let me see your question before I go further. Is it clear? Question on this? Okay, there's no question. Let's continue. Now, on my transaction date, which quarter are you talking about? Which quarter are you talking about? I didn't get you. Which quarters? Mr. Macha, which quarter are you talking about? That's what I just explained now. From March 1 to May to June 30th is how many months? 4 months. From 31 to May to June 31 is what? 1 month. So 1 month as at 31st of May, 1 month is left unexpired. 1 month out of 4. So you now come, you go and bring the closing neighbor. The question will give you your closing neighbor. If you look at the question, this is what the question gives us, a closing neighbor. That's our closing neighbor, Abby. This is our closing neighbor. If that's our closing neighbor, what is the balancing figure here? What will I subtract from 4 to get minus 0.1? That is 4.1. Okay, that is 4.1. So it means my unexpired basis is what? My unexpired basis is minus 0.1. And this is my future closing futures rate. Can you see that? This is opening futures rate, 3.9. 4.1 is the closing futures rate. Sorry. Let me refresh my brain. Let me refresh my brain. Yeah. Thank you for giving me the opportunity to refresh. Yes. Okay, shall I continue now? I think I've gotten my senses back now. Do we have any area that we are not clear here so far? The fact is that you need to go through what we are doing here very well before you can have confidence that you have known it. Otherwise, if you just want to hear it on this platform and you think you know it, you are just lying to yourself. You need to go and look at it over and over again. Look at it over and over again and master it. That's the way to go about edging. Otherwise, you have an issue. So let me see your concerns so far on this. I'm waiting. Sorry. I'm waiting. Look at it now. When you deduct 3.9 from 3.5, are you not going to get minus? You say, why is it minus? I said closing neighbor minus futures rate. When you say 3.5 minus 3.9, what are you going to get now? Okay, let us continue. Let us continue. Now, this is my closing futures price rate, 4.1, Abi. From there now, I can now get my closing futures price. You already know the principle. My closing futures price is not going to be what? 100 minus closing futures rate. So I have 95.9. I have 95.9. 95.9. is my closing futures price. So I will now come and compare. I will come and compare in order to compute my profit or loss on the futures. Profit or loss. I've sold futures at what? 96.1. And I'm now buying it at what? 95.6 closing futures price, Abby. So I'm making a profit of 0.5. I'm making a profit of 0.5. Okay. So what is our total profit? Let me give you the formula for this. Total profit is profit or loss per futures multiplied by number of contracts multiplied by exposure multiplied by loan period over 12. That is the proportion of interest we are paying. We are paying interest over 3 months, Abby. So it's going to be 3 over 12. So what do we have? Okay. So we have $5,000 as our total gain. $5,000 as our total gain. Can you see how to compute the gain now? You see that if you can follow these simple steps, you will find it very easy to solve question on hedging. The steps are what you need to watch, what you need to know. So I can now evaluate my hedge. Actual interest rate, that is, if I had not hedged, what rate will have applied? 4% will have applied to that transaction, isn't it? So I say 4% times my exposure times 3 over 12. I'm borrowing for how many months? I'm borrowing for 3 months. So that is $40,000. $40,000. Then profit or loss of future. This profit or loss, this profit rather, we are having profit there. The profit is expected to what? To reduce my payment. That is why I'm treating the profit as what? As an inflow. Then we are having margin above NIBOR. Margin above NIBOR, 1% of 4 million times 3 over 12. That is 10,000. So we have 45,000 naira as our net outcome. So for you to compute the outcome of the hedge, the first thing is you assume you did not hedge. You convert the transaction or you charge the transaction at the current interest, at the interest rate on the date of your transaction. Okay, then you recognize the profit on the future, then you recognize the margin above NIBOR. That is all what you need to do to get your net interest payment. So, question, please. That's that about this. Effective interest rate, the same thing we did under forward rate agreement. Effective interest rate is my net outcome of the hedge over my exposure times 12 over 3. 12 over 3, I'm converting to annual. This one is per month, for 3 months, 3 over 12. So here I want to compute it for 1 year. So it will be 12 over 3. So that's that about question 8. I now wait for a question in 1 minute. Okay, no question. If there's no question, let's continue. Let us continue. Okay, we have question. Okay, let me see. Which one? Okay, it's supposed to be what? Oh, okay. Okay, sorry about that. Sorry about that. That should be 0.2, right? Okay, thank you. Okay, let us continue. Let's go and take question 9. Okay, edge efficiency. Edge efficiency. Okay. Edge efficiency is edge efficiency is computed as a profit over loss. Profit over loss. Now, when we are dealing with futures, we can identify between two types of market: the futures market and the cash market. The futures market is the market where you can buy or sell futures, while the cash market is the market where you can get, you can borrow or what, or lend money. Okay. Now you have to look at these two markets. If you want to compute your edge efficiency, you look at which of them is giving you profit. One must be giving you profit and other must be giving you loss. Okay. Now, you cannot have profit from both, and you cannot have loss from both. It has to be profit loss, either from the future market or from the cash market. Anyone can give you the profit, and anyone can give you the loss. Okay. Okay. So, if I want to look at the profit, we have gotten profit on we have gotten our profit on the futures market, isn't it? Now, what is the loss? Because eventually, I must have a loss on the cash market. That's what it means. So what is the loss on the cash market? The loss on the cash market is computed by comparing the closing interest payment with what? With our target. Our target, this is the actual interest cost, the one we computed above. And our target is to pay interest at 3.5%. That is our current interest rate. Abi? That is our target. So you will see that we have paid above Abi, by 0.5. So our target is 40 million at 3.5% times 3 over 12, isn't it? But eventually, we have paid at 4%. Okay? We have paid at 4%. So when you compare the two, you see that if the transaction on the closing future, on the closing spot rate, will result into a loss of what? 10,000. So can you see that? We are making a profit on the futures and we are making a loss on the cash market. So I will not say my edge efficiency is profit over loss. Profit where? Profit from the futures and loss on the cash market. Abi? So times 100, we have 50% as our edge efficiency. Please, beg your pardon. We have to go and look at this. This we are doing very well. You have to go and look at them very well so that you build your confidence. The exam is nearby, so look at them. I know some of us will have been piling it up ever since we started, instead of it to be what? Doing it a bit by bit. Okay, it's never too late. Make sure you study them. Edging is a very it's a repeated topic in the ICANN exam, so you can't afford to joke with it. You can't afford to joke with it. It can give you a cheap mark. Okay, so let us take question number 9. Let us take question number 9. So what is the requirement of question 9? What is the outcome of the edge under the two circumstances? Okay. under consideration. What is the outcome of the hedge under the two circumstances under consideration? Now, let us go and look at the question and see. That's question 9. It is now 1st June. Princess PSC is to receive 340,000 pounds on 1st of August 2020. This amount will be invested for a period of 6 months. The company can invest at LIBOR minus 0.5%. LIBOR is currently 7%. This is anticipated to decrease by 0.85%. The company is considering hedging its exposure using option on futures. The following information is available. We have futures information. June 91.65, September 92.8. So according to this question, these are the two types of future contracts available. Are we together? Now, option information. Option information, we have put. It's not call to please, it's put. Put option, we have call option. Now, these are the strike price. Strike price is the same thing as exercise price, okay? Strike price or exercise price. We have June, we have September. We have June, we have September. 93.5. We have, these are the premium. The premium are stated under each of the months, okay? If you are buying June put option, this is the premium. If you are buying September put option, this is the premium. That is at 93.5 exercise price, okay? So for Ah. Please, I'm very, very sorry. The network has been very frustrating here. I've been trying to log in for the past several minutes. I've been able to do that. The funniest thing is that I'm having a class now. I'm having a physical class. So I want to appeal, please. I want to appeal that if it's possible for us to go through. How many questions do we have left? Let me see. Because 9, 10, we still have like 4 questions left. So please, will you just assist me to go through the solution of this question and ask me questions where you are not clear? The remaining 4 questions, because honestly, I'm having a physical class right now in the next 30 minutes, okay? And I have to take some rest before that time. Please, what is your opinion, please? Please. What is that? What do you want me to say to the group? Hello? What do you want me to say to the group? Mr. Mata, what do you want me to send to the group? You said, can we send it to the group? Okay, okay. Maybe that's what I'm going to do. Yeah, Felicia, you know, I have to take a rest before, lecture is this morning. I have to take a rest before that and find something to eat. I've not eaten as you see me here. Because I don't want to eat because I do have time. That's why I'm just appealing. You understand? Please. Please. My aim was to finish these questions today, but as it is now, we don't have any space left for that. You know, Monday will have taken it. Monday will be the general class for case study, so we won't be able to take it then. And tomorrow will be very busy, being the last day at the tuition house. Okay, so please, maybe I'm going to send the remaining part of the question to the group, and of course, it's on the main group already. So you can just help me to go through those questions, and where we are not clear, just let me know. Chat me privately. Okay, I heard you. I heard you now. I will do that. I'll do that. Chat me privately or on the group. I will explain. Or alternatively, I will write the procedure you need to take. Okay, the procedure for edging those things. I will write the procedure and send it to the group so that will guide you when we are reading when we are studying the solution. I think it's better that way, isn't it? I think it's better that way. I think it's better that way. So that okay. Suggestion, please. I want to receive your suggestion. Yeah, Felicia, I might not respond immediately, but definitely I will respond. It might not be immediate if I'm busy at that time. Definitely. Or what I'll do is I'll just be responding through live voice notes, so that will be easier for me. You understand? That should be the alternative. That should be the alternative, because the time to type might take a great amount of my time. So I just send a voice note to each of your questions, and I think that will be able to solve the problem. Abi? All right, thank you so much. Thank you very much. I want to wish you success in your exam. Obviously, we have done enough for you to pass, honestly speaking. If I've gone through what we have been doing on this platform, it's quite enough for you to pass this exam without any, except you have not been going through it, you don't understand it. If you understand it, it's enough for you to pass SFM. SFM is not it's not that difficult the way you people take it. Okay, it's just a little push that you need, and push you being able to go through what I've done on this platform. We still have some days, isn't it? So you can still revise, can still revise. So that all those gray areas, take your time, and God bless you. Success in your exam. Bye.